so many things you think about when you're trying to explain this market. The market doesn't like uncertainty, right? I'm so tired of talking about that.
Right.
You can't predict the unpredictable, right? Because, for instance, in the next 30 minutes, we could have another tweet, right? And it's just so difficult. And I think that's why you really have to kind of step back and really focus on.
Is it hard to tell if it's if the yield is this low? I mean, most people would say the yield can only be down here for bad and scary reasons. Do you think that's true? Or is there another way to look at this?
I think there's another way to look at this, and it comes about perspective, right? So if you go back to 2008, 2009, we had two recessions collide at the same time. This is like a once in an every other generation event. Perfect storms, right? You had a credit recession and a credit recession. Fed funds target was 0 to 25 basis points, okay? I'm hearing 0 all day long on TV and 0 last week from clients, right? And so that's why when the Fed came out and lowered by 25 basis points, we came out the day before and said there's a very good chance the market sells off. And we received some negative comments about that said, Belski, you're always bullish, right? So the market's going to go down. Yeah, the market's going to go down because a lot of the fast money momentum wanted more. Now you've seen the impacts of what the Fed said or didn't say post-statement. And then, of course, the next day, the saber rattling began, and then the market started to unwind. So I don't think the bond market's telling us anything about stocks right now. The bond market is in control with respect to momentum, and that's why, from a fundamental perspective, Kelly, you have to steer your investments more towards stability, cash flow, earnings, and really be more in terms of investing from a bottoms up and rely less on ETFs and more on stock positions.
And Barry, you're the king of that. Your picks here are Apple, Chevron, and Macy's. At least in Chevron and Macy's case, there's a lot of negative sentiment about these stocks. Apple may be more caution than at least elsewhere in tech. But do you agree with Brian? I mean, what information do you think we're getting from the 10-year here?
I think it's very simple. The rest of the world has much lower interest rates than we do. And people want our currency. They want our bonds so they can get some yield. And a strong dollar also is very attractive. And it pushes inflation overseas. So I don't see anything really to upset the apple cart in terms of rates continuing to go down. I do not see a recession. Our macro indicators, we have about 80 of them. Half are positive, half are negative. And the big things that we have are inverted yield curves and rising, unemployment claims. And one of those is positive, one of those is negative. So steady as she goes, maybe slower growth here, and that shouldn't have an impact on interest rates.